Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com. Today in my How Do series, we're going to talk about how do mortgage rates work. There isn't just one rate for everyone. There's all kinds of different levels of risk and different scenarios that determine the interest rate you're actually going to get. So today we're going to review what factors in to the interest rate you're actually going to get. All right, let's dive right in. So here is our system called Optima Blue. Many lenders use this system to be able to price out a loan to offer that rate to a particular client. So I'm going to put in a specific scenario, and as I go through the scenario, I'll show you some of the adjustments that are made on different types of loan scenarios. I mean, there's all kinds of different mortgages out there, so there's all kinds of different hits and offset of risk and interest rates that you'll receive. So in this scenario, let's do a $450,000 purchase with a loan amount of 405. So I put those right here into these boxes here. So that's 90% loan to value. The next thing you're going to see is loan purpose. This is a big factor on determining your interest rate. You have purchase, a rate and term refinance where you just take the existing balance and refinance it to a lower rate, or you have a cash out refi. Each one of those tiers has a different interest rate depending on all the other factors of the loan, like credit score, occupancy, things like that. So let's keep going through this. Next one is waiving escrows. Many states, if you don't have an escrow account, they can charge a fee to offset the risk. In Utah, many lenders will charge 0.25% if you waive the escrow account, and that's a fee, not to the interest rate. But you can offset that fee by charging a higher rate. So I would say it's very common. In Utah, almost everybody does an escrow account. And I think a big reason is the taxes are due in November every year. So right around the holidays, you've got this $1,200, $1,500 tax bill. Most people choose to just pay it monthly as part of their mortgage payment. Now, excuse me, let's go down to the borrower information. We're going to have a 740 credit score in this scenario, and I'll run the scenario with a lower credit score so you can see the different hits. So I'll leave that in there for 740, but you can see there's all kinds of other stuff. Can we verify their income? Can we verify their assets? Can we verify if they're self-employed, if there's an occupant, if they're a first-time home buyer? Here's a big one. Here is debt ratio. I'm going to put in 40%, just to have a number in the box for now, but the lower that is, the better the rate can potentially be. Here's another big one is properties financed. Fannie Mae and Freddie Mac allow up to 4 financed units for a certain set of rates and guidelines. Then they have a tier between 5 to 7, then another tier from 7 to 10. Generally, they'll want to see different debt ratios. They'll want to see a little higher credit scores. And the big one, they want to see a little bit more money in the bank in case renters miss their payments or something happens along those lines. So it's something where that's a big number on determining the interest rate as well as how many properties are financed. Now, you can own them free and clear without a problem, but as soon as they're financed, that's when you'll run into some different guidelines. So in the past, I've helped some clients that have more than, say, 4 or 7 properties. We'll refinance a few of them to maybe free up a couple other ones to be free and clear, or we cash out a couple of them to buy the next property. So there's definitely ways to make it work once you know which guideline you're running into. Next one is the occupancy. This is by far one of the biggest factors on interest rates. So you can see here you have primary residence, second home, then investment property. This is where it can get a little bit confusing on second home because it means that you have a primary residence, then you have a vacation home that you don't rent. People think, well, I'll rent it for maybe 3 months out of the year, 5 months out of the year, or I'll rent it and use it, rent it, use it. That turns it into an investment property. VRBO, or vacation rental by owner, VRBOs, have gotten very popular, but they do fall into the category of an investment property. Second homes are truly that, second homes, where they're vacant when you're not there and you use them maybe 6 months of the year, 8 months of the year. I have people that have different places they live for every 3 months of the year. And so all of those are actually second homes, but many times they try to convert those into rentals when they're not there. So keep in mind the type of occupancy is a huge factor on determining interest rates. And people tell me all the time, well, why? It's an investment property, it's making money, there's a renter in there. But think of it this way. If you run into hard times, you have your primary residence where you and your family, your kids, everybody's going to school, going to work, all that kind of stuff. That's where you live. And then you have an investment property and the renter stops making their payment, or they trash the place, or you lose your job. You're more likely to start missing the payment on the rental property than you are your primary residence. So they just simply go into default more often. So they have more problems if all of a sudden the place is not rentable for some reason, or rules change, or all kinds of factors. They're just a different level of risk, so they come with higher interest rates. Then we've got the property type. You can see here all kinds of different types, and there's different rates, whether it's a single family residence, a condominium, a planned unit development, or PUD, as it says here. Manufactured homes are completely different. So in fact, some lenders don't even loan on a manufactured home. Then you've got condo tels, townhomes, modular, detached condos. There's all kinds of different property types. With each one of these has a different level of risk. So the rates also compensate for that. Here's another one: number of units, 1 to 4 units. Now, anything more than 4 units, even if it's residential, zoned and residential use, is considered a commercial property. So only 1 to 4 units are actually considered residential loans or residential properties. You have number of stories, then you have zip code, you have county, you have state. Even some states have different rates based on risk of default or risk of certain insurances or risk of other things. They'll actually see slightly different rates during in certain different regions. So that's all factored into the rates. So we're going to leave this. We'll do here Washington County. That's where I'm located, just to have a number in the box again. Then you have the type of loan itself, whether it's a conforming loan, a government loan. Those have different rates as well. You have the loan term, whether it's a 30-year, 20-year, a 15-year. You have all kinds of different arms. So you can do a 5-year arm, a 7-year arm. So all of these have different rates after they factor all this stuff in there. So you got all this stuff that we go through and the type of term. It's all kind of calculated based on everything that's going involved. And then that's when it determines an interest rate. So let's go ahead and hit submit with this scenario. Hopefully we got everything in there right. Okay. So let's go. This is all the arms. Let me revise that real quick. Let's just drop off the arms to make it easy. I think I clicked, yep, I did click that box. Okay, let's submit again. Okay, so we'll just jump into, let's say, this one. So you can see here is all the rates that are available. These numbers here that you can see are the cost to get that rate. That's where points kick in. So you can see sometimes there's big jumps, sometimes there's tiny jumps, sometimes there's larger jumps. It just depends on where the pricing is of that particular day. But this is the idea of where rates would be under this particular scenario. Then down here, you can see all the adjustments. So you can see right here, the FICO score being above that 740 gets a point hit or a certain hit to that particular interest rate. So that's going up to 90% with that FICO score. So let's go ahead and play with this some more. So let's revise the search. Let's say the credit score isn't 740. Let's say it's 680. Let's see how that changes things. So then we jump back into here. And there's the rate differences. So you can see that score made a big difference to the interest rate by having that higher score, because you can see now the hit, instead of being a quarter, is 1.25 for that credit range. And you can see it's a range. Most credit scores are based on a 20-point range. So you get the same credit score hit from 680 up to 699. Then you get a different tier if you're above that. So let's change some other things in here. So let's go up here and revise the search again. Let's say that this isn't a refi, or sorry, this isn't a purchase, this is a refinance. And let's put more money down. So let's say the value is still 450. And let's say, let's do 75%. Now we're going to change, wrong box. Change this back to 450. Okay, so now we're at 75%, but now we're a cash out refi with the 680 credit score. So let's go down here and submit again. Dun, 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 dun. So we'll jump back in here, 30-year fixed, and bam. So now, whoops, let's go down right here. There we go. So now you can see the other hits. So now that it's a cash out refi between 70 to 75% with the credit score of 680, not only is there the 680 hit for the score, but now the combination of cash out and credit score, now you've got 2.375% hits to the rate. So that's what's built into these prices up here. So that's where you can see these rates with those fees are factoring in the hits to do that particular loan. So let's play with some more. Now, let's go back into revise. All right. Let's say now it's just a rate and term refi. Let's change it to a investment property. Let's see what that does. So kind of the same loan amount, same value, credit score is the same. Now you can start seeing some big hits because of that scenario. So now when you come down here, now you've got the same 1.25, but now you've got investment property as a 2.125% hit for a total of 3.375. So you can now see those hits really start affecting the interest rate because now you're tying into these bigger hits. So I hope that helps to give you an idea. There isn't just one rate. There isn't just one way of calculating it. So when you call them and say, hey, what's your rate for today? You can get an average of where rates are, but it depends on what loan to value, depends on credit score, depends on use, depends on all kinds of different factors before you can get an actual interest rate. So that's how mortgage rates work. If you have any questions, comments, or concerns, please leave them below. If you'd like to apply for a mortgage loan to refinance or buy a home, I'd love to help you. I'm in Utah and Nevada and love an opportunity to help you. So go to my website at ryanbolt.com. But look forward to working with you again and look forward to doing more videos. Thanks for your time.